Welcome to Money Talk, a Mainsail Financial Group podcast series where we host industry experts and local professionals to share some guidance, tips, tricks into what is typically some of the areas that we don't necessarily get a focus on. But today we're switching things up here a little bit. We've got our very own Samantha Kennedy to join us and talk all things equity compensation plans. So Sam, thanks so much for joining us today.
Absolutely. Thank you for inviting me.
Yeah. And we're actually out here at Dilettante in the Belfield Office Park. So this has been a place that we go to quite a bit. Our office is right down the street and just a really cool spot, especially on a nice sunny day like this. So great place to host you and excited to kind of jump into the conversation today.
Yes, absolutely.
So maybe to start, I figured we could start really high level and then kind of dig in as we go. Mm-hmm. Can you just kind of share just generally, so equity, stock compensation plans, talk a little bit about what they are, what they're meant to do, and some of the basics, I guess.
Absolutely. Well, being located in the Pacific Northwest, where we have a lot of tech firms, Google, Microsoft, Amazon, Facebook, a lot of times equity stock options are used as an additional form of compensation. So because those big companies have stocks that are worth quite a bit of money, depending on the value day to day, it's a way for the firm to be able to reward their employees that isn't exactly cash out of the company's pocket, although it might be moving stocks on the balance sheet.
Sure. Perfect. Yeah. And obviously, to your point, especially in this area, these compensation plans are extremely important to make the most of, to make sure you fully understand. And we'll also talk a little bit as we maybe wrap up today about how you incorporate earnings season into that too. So obviously a really relevant topic here in the area. So maybe to start, can you just talk about some of the high level versions of these equity compensation plans that are out there?
Mm-hmm. Absolutely. So I thought we would maybe talk through three high-level ones today. So the first one is an ESPP, or Employee Stock Purchase Plan. So this one's a little bit different. It is a form of additional compensation because employees are able to buy their company stock at a discount. However, they actually need to buy that stock, so they have money going out of their pocket. That is quite different from an RSU, or restricted stock unit, where that is a grant from the company to the employee, but that is just seen as essentially the same as W-2 income, or really even cash compensation. So the difference between an ESPP, Employee Stock Purchase Plan, and RSU, Restricted Stock Unit, is the employee has to purchase the share in the ESPP, albeit at a discount, and the RSUs are simply granted. Now, both of those have the same timeline in terms of capital gains. So if you hold that for less than a year, that is short term, meaning at ordinary income rates. If it is a year or longer, then it's long-term capital gains. The last one, which is probably the most complex of the three we'll chat about today, is the NSO, the non-qualified stock option. And that is where sort of the easiest way to remember it is if you have option in the word, employees have to have cash go out of their pocket. So the NSO, or non-qualified stock option, employees technically never have to exercise those. It's an option to buy their company's stock. Those tend to be more common with non-publicly traded companies, so not necessarily the big tech firms, but essentially there's something called a strike price, which is what the value of the stock is when it's granted, and then fair market price, where in theory, hopefully the value of the share goes up. So if an employee chooses to exercise an NSO, they are taxed at ordinary income for the difference between the fair market value and the strike price, but then any gain on top of that would be long-term or short-term capital gains.
Okay. And then we don't necessarily need to break this apart, but there is also this ISO out there, incentive stock option, that provides some tax benefits. Can you just touch briefly on that for anybody who may have those plans available?
Yes. So ISOs are very similar to NSOs in terms of smaller companies, or companies that are non-publicly traded, tend to use them. But the difference between ISO is when they're exercised, it's actually not a taxable event. So the other piece, and when we are mentioning throughout our conversation ordinary income tax, or W-2, if you see that on your pay stub, versus long-term capital gains, there tends to be favorable tax rates if you are able to get in the capital gains world. And so ISOs are extremely beneficial if you hold them for a certain amount of time, where all of that stock value could be potentially long-term capital gain rather than your ordinary income. And especially if you are making in the hundreds of thousands each year, that can be a big difference over the long term.
Great. Okay. And maybe what we'll do is we'll kind of break down each now. So I think you started with the stock purchase plan, right? Mm-hmm. Obviously, leads you to believe you need to purchase, as you had mentioned, and typically that's at a discount. Can you just expand on that a little bit more, where you typically see the discounts, how you typically see people using these, and maybe some considerations if you find yourself, in having this as an option for a plan?
Yes, absolutely. And I might use Microsoft as an example because a lot of Microsoft employees use the ESPP. And the most common way I have seen it used is honestly similar to contributing to a 401k. So what I mean by that is having a little bit of each paycheck come out, but rather than going to taxes or go to future retirement savings, that bulk of money is being used to purchase, in this case, Microsoft stock. So on average, you are able to purchase it at a 15% discount. And so using just easy numbers, if Microsoft, I know this is not the case, but if Microsoft is trading for $100, you as an employee of Microsoft would be able to buy it for $85. Now, there are some caveats or sort of fine print. Usually when you use the ESPP, you do have to hold on to the stock for about 6 months. So it's not something you can turn around that return immediately. And then the second piece to that is you are limited. So in theory, if you can buy a stock at a discount, why would you not buy, assuming you have this, millions and millions of dollars? So ESPPs, you are capped to $25,000 a year. So it's a huge benefit. It's a way for Microsoft to benefit their employees and sort of align incentives where the employees are investing in the company they work for. But it does come at a bit of a cost, meaning cash flow. So that is money where you are using it to purchase a stock. However, that is money you are not seeing day to day.
Yeah, that makes sense. And obviously that built-in return also implies tax consequences. The RSUs, maybe let's transition there, and obviously Microsoft has those as well. A lot of other companies do too. Just maybe share a little bit more about that, and then also, how you see individuals using those plans.
Absolutely. So the RSUs, and as you mentioned, Microsoft has those, Amazon does as well, as does Google. And so with the RSUs, it's a little bit different than the ESPP, meaning the employee to some extent doesn't have any control over the timing of that. So although RSUs, restricted stock units, is a share of stock, so it's not cash incentive, it is treated as if you are paid cash equivalent to the stock value at the day of the grant. So because the timing piece is not as controllable, the question is for most employees who have RSUs is, do you sell and cover the tax? That just means sell the shares to pay the tax that are due on them and diversify. Or do you just hold on to them, assuming that maybe your company is going in the positive direction and to gain some of those favorable long-term tax rates? So the maybe not so short way to answer that is I think it depends on the employee's objectives. And so if you are very bullish on the company you work for, there probably isn't much harm to hold on to some of the RSUs. However, where we see some trouble in terms of long-term planning is when 25% of your compensation is in your company's stock. It doesn't take many years for that to be over 50% of your overall investable assets. The other piece to that is even though we have favorable tax rates rather than ordinary income, if all you have is long-term capital gains and it's a huge amount, to diversify that can take a lot of time. And if you actually need that money, it's not going to be as flexible, meaning tax-free potentially, as perhaps a portfolio that's a little bit more diversified.
Sure. Yeah. And obviously now with the Washington State capital gains tax, another thing to consider for Washington State Microsoft employees and alike. So so with the two plans there, like we talk about this quite a bit internally, can you just kind of share a little bit about how you look at those two in conjunction in terms of like more strategic ways to use them?
Yes. So again, I think it differs employee to employee. Sometimes it can be a bit tricky because if cash flow is tight, as odd as it might sound, even though the ESPP is very attractive, until there's some wiggle room month to month, we might actually ignore that benefit. Mm-hmm. And the reason for that is from a planning perspective, if you are worried about your next paycheck, if there is no wiggle room, you're constantly playing catch up. So although it's a very attractive benefit, we would actually recommend maybe ignoring it for about a year, building an emergency reserve, and then taking advantage of that discount in terms of the stock price. Now, in terms of RSUs, that is a similar story. However, again, we're not able to control the timing on that. So if cash flow is troublesome, what we want to do is make sure that we're not buying equity in a company and sort of sacrificing resources you can use today and building up credit card debt or something of that sort. But when you have the option of those two plans, and assuming that cash flow is solid, it's a bit of a hybrid situation. So what we would recommend is buying the stock at a discount, because on paper you immediately have a return, and likely selling upon vest some of the RSUs, because when you have an ESPP and restricted stock units being awarded every 3 months or every 6 months, that becomes your whole portfolio overnight. And so I think if you're guaranteed to some extent a 15% discount, then we want to take advantage of that. We want to take into account the fact that that will minimize your cash flow. If we just straight normalize it month to month, it's about $2,000 going out the door each month. And then likely that can be covered quite easily from a cash perspective through the RSUs that are vesting. And then hopefully it presents an opportunity to diversify your portfolio a little bit.
Okay, that's great. And a lot of times, what we've seen is when people have both ESPP and RSU, the timing of sales and purchases can get a little confusing. Something that often can be run into is called that wash sale rule. Mm-hmm. Can you just talk a little bit to that and how that works?
Yes. So the wash sale rule, now I do feel like we need a disclosure here. We're not accountants, we're not CPAs, but high level, the wash sale rule cancels any gain or loss that you have if you purchase a like security within the same 60 days. So what that means is, again, let's go and pretend Microsoft is $100 again. If you have 100 shares of Microsoft and they were awarded to you at $10, and then let's make this a little bit easier. 10 shares of Microsoft awarded to you at $10. And now let's say the market value is $100. Well, if you sell those on paper, you have a $900 gain. If you hold them longer than a year long term, if less than a year short term. However, if you make that sell and then you're awarded new RSUs, that is viewed as canceling that event. And so essentially, whatever trade you made in the past is a wash from the IRS perspective. And so you still have the same basis that you would from the original transaction.
Basically, the receipt of the RSUs is considered a buy, right? Is that the idea? Got it. Okay. Mm-hmm. Yep, that makes sense. We won't spend a lot of time because stock options, both NSOs and ISOs, are a little more strategic, a little more personalized based on the individual. But just briefly, can you maybe share some thoughts as far as strategy around the NSO side of things?
Yes. And I think maybe just piggybacking on the complexity of NSOs and ISOs, unlike RSUs, the rules can change company to company as well. And what I mean by that is the company gets to decide when they offer these shares, what the share price is. And so even though there might be a fair market value, if you choose to exercise the option, that is to some extent phantom, because more often than not, ISOs and NSOs are not publicly traded. So that is where it gets a little bit complex. The other piece is you need to have quite a bit of cash on hand to actually exercise these options. So both NSOs and ISOs require you to buy the option or buy the right to hold on to your company's share, which in this case might be on paper if it's not publicly traded. And so there's a couple pieces to that. ISOs have sort of stronger handcuffs, meaning you need to satisfy other conditions to have that long-term capital gain. But either way, you need to be sure that you have enough money on hand. In the NSO world, you need to make sure you have enough money to buy the share itself at the offer price, but also be able to pay the tax if it is a huge gain. And so yes, exactly what you said. It can be a little bit more complicated, and the advice on that is very company specific and individual specific rather than sort of a blanket statement.
Sure. Okay, that's helpful though. Helpful start anyway. Mm-hmm. Maybe last thing to finish up on today is here we are May 1st, I think. So basically, we're in the heat of earnings season. Some of the big companies, Microsoft, Facebook, Amazon, have already reported, but we're in the middle of it. So how do you kind of factor in earnings season as it relates to these different stock plans as well?
Yes. So earnings season this year, and albeit I think anytime we're talking about the world, there's interesting factors going on, but earnings season combined with layoffs is an interesting I guess maybe concoction is how I'd phrase it. And so what I mean by that is, at least on paper, usually layoffs from a market perspective are seen as a positive. And the reason for that is the company is minimizing their expenses on paper. Where that combines with stocks or stocks that might be awarded is you might need to actually track your company's stock quite closely, because if they have a positive earnings season, usually there's a little bit of a bump. And if that happens to align in exactly the window of your stocks being awarded, if you're actually able to get a little bit of a gain, or maybe it makes sense to use that stock award for something else as part of your financial plan, you need to make that decision quite quickly. On the downside, of course, is if there's a negative report, or maybe your stock takes a little bit of a dip, you might need to pivot. And depending on your thoughts, and assuming that cash flow and all the other pieces of your financial plan are okay, and we're able to just build tax efficient strategies at this point, you might need to hold tight, because there's not only earnings season when the stocks are awarded, but usually, and depending on your position in these companies, you might have a trading window. So you might not be able to make this decision anytime you want. So there are a lot of planning components around earnings season to consider, especially for those more rapid, timely,
Sure.
I guess, reactions.
Yeah, and so I think so. The second part is obviously really clear, especially if you know you have these trading windows. The first part, what I think I'm hearing you say is like basically the strategies that you talked about earlier can be good blanket strategies, but at the end of the day, earnings are going to dictate price movement. And so, although that may be the general idea, depending on what happens, you may want to give or take, or kind of be more strategic around it. Is that fair to say?
Yes.
Okay. Perfect. Well, I think that's a really good kind of conversation, maybe a good place to start wrapping it up. But is there anything else you want to add to the conversation around equity compensation plans here?
I think just high level, if it's something you've heard mentioned and it's been out of sight, out of mind, I would just encourage you to maybe read your company's documentation, as difficult as that might be. Or, of course, as you all know, we are happy to be a resource and be a second set of eyes over that. But equity compensation can be a huge piece, if not the majority, of one's financial life before much time passes. And so if this is offered, I guess just the strong encouragement would be to learn about that resource and see if it makes sense to use.
Okay. And this sounds kind of funny saying this with you internally here, but if anybody does have questions for you, how do they get in touch with you?
Yes, absolutely. So I'm Samantha Kennedy, a financial advisor at Mainsail Financial Group. You can reach me at samantha@mainsailfg.com via email, or 425-679-6736.
Perfect. Well, thanks so much for joining us today.
Thank you.
And thank you guys all for listening in. Of course, if you have any questions for us more generally, you can reach out info@mainsailfg.com.